With this investment, you can generate deductions to take against your income every single year while the investment grows. In this video, we're going to walk through how the heck that's even possible and why it's one of the best strategies out there for high earners. Obviously, any investment that offsets income is going to be disproportionately beneficial to those that have a large amount of income, but it works with a bunch of different kinds of income, whether that's earned income in the form of W-2 or 1099, or you have a big portfolio with credit strategies that are producing a large amount of investment income. So let's set the scene. Why is this a big deal? Most people I work with are in California and they're high earners. So what that means is their all-in tax rate, combining state and federal, is often around 50%. And if you're making $1 or $2 million a year, you're probably working pretty hard for it. And year after year, you're watching your 7-figure income just get cut in half. Sometimes it's taking you from a 7-figure salary down to something that's more like 6 figures after all the taxes. And the vast majority of tax beneficial investments can't help you solve this problem. The depreciation you're getting from your real estate properties is probably being classified as passive because you can't demonstrate to the IRS that yes, you're a high W-2 1099 income earner, and at the same time you want to claim real estate professional status managing a rental property. It just doesn't work. So even though the depreciation is great, it stays sort of at the passive level, and you can use it against the rental income you're getting from this property, but you can't actually take those paper losses and use them to offset the income that you're making from your job. And tax loss harvesting is awesome, especially when you go long and short, like we talked about in the last video. But those losses cannot be used to offset ordinary income, just capital gains. So ordinary and capital are sort of in their own worlds, and the deductions that you're getting can only be used to offset the respective kind. So if I have a capital gain event, I can use capital losses from tax loss harvesting to offset that. But if I have ordinary income, it doesn't really do much when you have capital losses because you can only use $3,000 a year of capital losses to offset ordinary income. So the solution for those with high income are tax-aware hedge funds. The term hedge fund gets thrown around out there so much these days, it probably doesn't mean a lot to you. So at a high level, a hedge fund is more of just a structure these days as opposed to a particular strategy. Within the hedge fund universe, you've got dozens of different kinds of strategies that could be happening in the hedge fund. You've got long, short, managed futures or trend following, merger arbitrage, convertible bond arbitrage, global macro, and there's much more. So maybe we'll do a video about hedge fund strategies at another time and kind of dive into what those look like. But for now, we'll just stay at a high level and say that there are different kinds of tax-aware hedge funds out there that are running some of the different styles that you might want for your hedge fund exposure. And what I like to do is use ones called a multi-strat, which just means multiple strategies, because what that does is it combines all the different uncorrelated return streams of these different strategies. And when you roll them up into one, it creates a really attractive risk-adjusted return profile that's super beneficial to adding to any sort of traditional portfolio of stocks and bonds. Okay, so the way that it works is the hedge fund elects for something called trader status, and that does two important things. Number one, it allows the fees to be deductible. If it's a typical 2 and 20 fee structure, that would mean after taxes, if you're in the 50% tax bracket, the fees are more like 1 in 10, if that's how you want to think about it. The second thing it allows for is the tax character of the strategy being run to get passed through straight to the end LP investor. So that, combined with the fact that there are specific derivative contracts that are treated as ordinary for tax purposes, you can then pass, if there are ordinary losses on those contracts, straight through to the investors. Now, what you'll see as an investor are these losses, they'll come to you on the K-1 tax form that you'll receive. So now when you go to file your taxes, and I work with everyone's CPA so that they know what's coming and we can kind of prepare ahead of time. But what they'll see is when they file, we'll have something called an excess business loss or EBL, and that's deductible against W-2 1099 and an investment income. One important thing when it comes to your employment income, there is currently a cap on the deduction that you can take. So for a married couple this year, it's around $610,000. Any excess deduction you have over that gets reclassified as a net operating loss, or NOL, and that gets carried forward into future years. And there's some nuance to that I am not going to get into in this video. All right, so let's talk about some real life use cases that I've got going for people with this strategy. First one is the simplest. It's just a very high earning couple making almost $2 million a year, losing about 50% of that to taxes. So we plug this investment into their portfolio, and let's say we get a $500,000 deduction. What that does is that creates a real $250,000 in tax savings that just goes right into their pocket. Now it's up to them what they want to do for it. What they've elected to do, and what I usually recommend to people, is just reinvest it back in the portfolio, because that way we can compound and grow it even faster. But for every additional dollar you put into one of these tax-aware portfolios that I manage, your tax savings increase the very next year. So you can see it's kind of like this snowball that just keeps growing, whereas the portfolio grows, the tax savings grow, then the portfolio grows, and then the tax savings grow, and it just keeps going in a positive feedback loop. Another common example are people I come across that have just been sold the dream on private credit. So a huge part of their portfolios are just ordinary income being paid out from these private credit funds that they're invested in. You just take this strategy, you plug it in as part of the portfolio, and then what it does is it creates this offset against all of this investment income that's coming from your private credit investments, and then the net is a far more tax efficient portfolio. I also like to use it for people when they're actually in retirement. We start to tilt the portfolio into more income producing strategies. Well, the problem with most income producing investments that you do is the tax treatment is just horrendous. So what you do is you add this strategy into the portfolio mix, and suddenly those income producing strategies that you're using to live off of, you're able to shield that income from taxes. One of my favorite uses for this strategy is for Roth conversions, where you're moving money from your traditional retirement accounts into a Roth. Once it's in the Roth, you never pay taxes again. Retirement accounts or deferred comp plans are essentially just this ever-growing pile of money that you owe taxes on the second you try to take it out. So what usually makes sense is we'll use this Taxaware hedge fund strategy to give you the offset and deductions you need when you're working against your earned income. But then when you retire, income usually drops substantially. We'll create the income for you because we have an offset for it in the form of converting your retirement account assets over into a Roth IRA. If you just look up Roth conversions, you'll see that it's a strategy that a lot of people implement, because depending on the timing and what tax bracket you're in, it can be advantageous for your lifetime tax bill to be lower if you execute them in those early years in retirement. So if you're already going to be doing a Roth conversion, go ahead and add this strategy to it, and then you're offsetting the income that you're sort of realizing or triggering when you do the conversion. A couple other examples that have come up, people with large liquidity events. So sometimes the tax treatment of the sale of a business or some big private equity deal that you're a part of, it won't all be capital gains. Sometimes some of it has some sort of like earn out component where you're going to be paid out income that is taxed as ordinary. And this strategy is a nice one to add in with the long short tax loss harvesting, just to make sure that you're able to offset whatever the particular treatment is of your liquidity event. Another example this is great for is when you're being granted large amounts of RSUs or non-qualified stock options, because both of those are going to create ordinary income for you. Lastly, there have been a few people who were doing the short-term rental strategy, which, going back to what I was saying earlier, it's sort of the loophole that you can try to pull off, which even if you have a full-time job, if you have a short-term rental, which means the average stay is 7 days or less, you might be able to use that depreciation on that property to offset your ordinary income. Well, a few people I've started working with were just sick of managing their own rental properties because they're pitched on this great idea, and it is great. Like, if you can offset your income, the benefits are massive. But what do you want to do? Do you want to keep buying more and more rental properties and be responsible for managing them? A lot of people end up not wanting to do that anymore, so they ditch their rental properties and they start just using this strategy exclusively to be the offset for their ordinary income. All right, so the risks to this strategy are just the same as any other tax advantage investment that you're going to do. What the IRS wants to see is that there is economic substance for the investment, meaning you're not just doing it for tax purposes. And these strategies check that box no problem, because there's a real uncorrelated return that we expect and have gotten so far from these strategies, where if we ignored taxes, they have a place in a portfolio anyways. They just happen to come with tax benefits. All right, in conclusion, if you're a high earner, have large RSU vesting, or a business exit coming up, this strategy can literally change your life. When you can reduce the taxes you're paying on the highest marginal bracket, it has a profound impact on your ability to grow wealth. If you liked the video and want to see more like it, go ahead and hit the subscribe button, and I'll see you in the next video.